Good morning. Welcome to Forex in Four. Today is Thursday, December 1st, 2011. All right. Well, we had quite the close to the month of November yesterday, marked by a 400-point gain in the Dow Jones Industrial Average. But I got to tell you, it's what's interesting about it is that with that gain and the last couple days rallies that we've had, we're essentially flat for the month. So that gives you an idea of where we came from prior to yesterday's moves. So, what's always interesting about doing the video is that, I tend to do this a little bit earlier in the morning just to get an idea of, what's going on, tell you what to expect later in the day. But yesterday's action was completely unexpected. And essentially what happened is that central banks, 6 central banks around the globe, Bank of Japan, Bank of England, ECB, Bank of Canada, U.S. Fed, and I don't know, Swiss National Bank. Those are the 6. Thank you. They all agreed to reduce swap lines from one another. So all they did was they reduced the cost of lending, which means that banks can free up money elsewhere, which means that there's more liquidity in the system, which is hopefully going to prevent liquidity crises from happening. Well, the problem is that we've been talking about this euro debt crisis, and boom, the markets exploded yesterday on those moves. And we can look back here, and you can see on this 1-hour chart. Here's the Aussie. All right, it was risk on yesterday, like nobody's business. The problem is though is that it takes away from the focus on the ECB and the debt crisis. All right, now the ECB, the European debt crisis, has not been solved. All right, just be very clear about that. They still have a huge problem over there. All it means is that they freed up some capital to be able to deal with it. But at the end of the day, people are thinking, wait a second, why'd they make this move? All right, perhaps there were some banks that were in trouble in Europe. All right, nobody knows who it was, but there's the finger pointing starting to go on. But at the end of the day, the crisis there is still very real. And all this has done is bought them some time. So if they don't come up with a solution, PDQ, it's going to be a continuing problem. So we've been looking at the Aussie here. I just want to show you, boom, you can see this move here. Looks like we're setting up a little bit of a bull flag here. I don't want to go ahead and start making claims right out of the gate. But, on Wednesday, I said that we could probably get to 102.50 by the end of the week. Well, we got there, again, PDQ on this move. So this is starting to look like a little bit of a bull flag here. If this thing can hold the pivot line at, let's just call it 101.80, all right, we could get another bounce and another leg higher. And if we go back and look at this, I don't know, let's say the 4-hour chart, okay, you can see what I'm talking about. So we may get another move higher here, depending upon what comes out later this week. And again, we have non-farm payrolls coming out tomorrow, so that could be the catalyst. So you can see here all the risk currencies, boom, moved higher. Charts all look the same. You can't tell one from the next. The difference is that it was all based on dollar weakness, right? All right, more U.S. dollars in the system as the world's reserve currency, thanks to this move yesterday. So what else did we get yesterday? ADP jobs report, awesome. It was the perfect storm, basically. Is that every number came in better than expected, and that's a good thing. But it's setting up for tomorrow, perhaps maybe a little bit of disappointment in non-farm payrolls, which is the most important figure that we look at. So let's talk about what's happening this morning. The reason I had the Aussie up, and I apologize, let's go back to that. I'm a little bit scatterbrained this morning, is that they actually had retail sales figures which came in worse than expected, 0.2% versus 0.4%, and building approvals were down as well. Chinese PMI, also lower than expected, 49 versus 49.9. So things aren't, boom, moving gangbusters, all right? But it seems like all of this global liquidity going on, money is driving, cash to commodities. And we can look here at oil. Oil's right at $100. All right, boom, spiked yesterday. $100 oil. All right, market pundits will tell you this is a great thing for the economy. Guess what? I don't think so. No offense, but I drive a car sometimes. And I buy food, which sometimes needs to be transported to this little island I live on called Manhattan in New York, and that costs money as well. So that means things cost more when oil's at $100 a barrel, which translates to inflation. All right, these guys are begging for inflation. Please, inflate, inflate, inflate. Well, guess what? I don't think inflation at this point is the answer. All right, you've got 9% unemployment here in the U.S. Global unemployment is, who knows where it is. You've got countries like Brazil who just cut interest rates again today, despite the inflation they have there. and this whole thing's coming to a head. So it's not a pretty situation by any means. Just want to show you here. We're going to look at the Swiss franc. All right, boom, trading this range. We actually, have been coming in over the last couple of days, and we moved higher in that risk move, and then euro, boom, it tanked versus Swissy. Well, Swiss GDP came in lower than expected, 1.3 on the year over year versus 1.8, but the quarterly number was a little bit better than expected, so I'm not exactly sure how to rectify those numbers. Later today, we're going to get U.S. initial jobless claims, ISM manufacturing, construction spending, and that's all ahead of tomorrow's non-farm payrolls report. So there's a lot going on in the markets right now. We're hoping to see improving fundamental data, but for a while I've been saying it just seems like the markets want to fly higher. All right, the only thing really standing in its way has been this euro debt crisis. And you can see here, there's the dollar weakness versus yen. So, again, I think we're going to rally going into the end of the year. The numbers are going to be okay. Everyone's going to put the nice window dressing on. If you're a fund manager, you're going to be happy. You can tell everybody, yeah, look at my performance for this year. But come the beginning of next year, if the ECB doesn't figure it out, if Eurozone leaders can't get together, if they can't figure out how to, lower the yield on sovereign debt in the EU, we're going to be right back at the same place. So, for the time, everybody feels good. Hey, that's great. But, let's not lose sight of the bigger picture that the Eurozone still has a lot of work to do. So, in any event, that's what I've got for this morning. Good trading to all.